Thanks so much for tuning into Talking Point. I'm your host, Neeraj, and it's an interesting talking point day today. Of course, the primary markets are buzzing, and not just in India, as we all know about the kind of response that the South Korean IPO seems to have gotten. We have our very own tech multi-con, if I can call it that, getting listed, and the equity markets are getting bought into in a matter of days when there are dips. So much to talk about with Mahesh Nandurkar as we try and pick his brains around how does he see the current market behavior and what does it tell him about how the markets could be over the course of the next 6 months. Mahesh, great having you. Thanks so much for joining in. I hope all is safe.
Thank you, Neeraj. Thank you for inviting.
Now, the pleasure is ours, Mahesh. Mahesh, the reason I said 6 months is because 1 year seems to be too long a time frame in the current juncture. But what's your sense about the behavior, Mahesh? I mean, we seem to be shrugging off negative cues whenever they come in, both on the global and the local front.
Yeah, that's true, Neeraj. And as you rightly mentioned, it's a global phenomenon, not just an Indian phenomenon. So India is just a part of the global wave, and the global wave of liquidity, right? And so therefore, the key focus area for many of the investors that we speak to, and myself included, clearly the focus is a lot on what is happening in the US, what's happening with the Fed, whether they are going to talk about taper, talk about some possible risk, etc. And it's been a very volatile last 3-4 months. I mean, it's very interesting how quickly we've moved from an inflation scare, which was the case, I would say, even as late as 2 weeks back, and then suddenly the US bond yields have collapsed, and we are now talking about a growth scare. So the global cues, the global inputs have been very volatile. Yeah, thankfully, it hasn't really created a lot of volatility in the equity markets, although a lot of volatility in the bond market, but not so much in the equity market. We have been, going, up, in kind of only one direction. But yeah, I think there are a lot of risk and a lot of global factors to watch out for before we can conclude, which way things are going to be moving.
What does your experience tell you, Mahesh, about how this might shape up? Because as you rightly said, the inflation scare is kind of dissipated in a matter of, or rather moved on to another in a matter of less than 2 weeks. So what does this tell you about the way markets are behaving and whether it's possible or whether it's prudent to try and predict what could happen 6 months out as well?
Yeah, Neeraj, very valid question. And, clearly you mentioned right in the beginning that rather than 12 months, 6 months is a better time frame to talk, to talk about. But, I can tell you in 6 months is not that easy, as you would imagine. Yeah, see, the thing is, we are clearly seeing the cycles have become very short, especially the market cycles. I am not, so sure about the economic cycle. I still feel that the economic cycles are not as short. But the market cycles, have definitely become shorter, and therefore, I would say it's easier to take a call on economic growth outlook, more difficult to take a call on market outlook, so to speak. But yes, I mean, we are all in the markets. We have to take, our calls. So what I can say is that we are still quite positive on the economic outlook perspective globally, and definitely in India. We believe that we are at the bottom of the economic cycle, and the next 3 to 5 years should be very good economically speaking. But that doesn't necessarily mean that the markets would also be rocking over the next, say, 6 months or 1 year or so, because the market has been factoring in a lot, already. And if you look at the broader P multiples, and while those multiples are clearly significantly higher than what we have been used to seeing over the last 5 to 7 years, but then so are the risk-free rates as well, significantly lower than what we've been used to seeing. And the lower risk-free rates, the lower GSEC rates globally and also in India do justify the current kind of valuation. But at the margin, I would say that the bond yield and earnings yield gap, this is one very important parameter that we track very, very closely. I mean, right now the 10-year GSEC yield in India is about 6.2%, and we know that that the 10-year GSEC has kind of I wouldn't say lost its relevance, but we know that it is like heavily uh, managed. The yields over there are like heavily managed. So maybe the real yields could be 10, 20 basis point higher, if not more. And in comparison to that, if you look at the P multiple that the Nifty is trading at, which is about 21 times, and then if you just take 1 by P multiple, which is like the earnings yield, that's about say close to 4.9, 4.8%. So the gap between, let's say, the adjusted 10-year, which is about 6.4%, and the earnings yield at about 4.9, it's about 1.5 percentage point. It's definitely on the higher side, and it's slightly going into the uncomfortable zone. And especially if we now believe that the yields in India are going to go up, maybe by 20, 30, 50 basis point, whatever, then this equation is going to look even worse, and in my view calls for market multiple derating. Thankfully, we are in a strong earnings growth environment. So if the market multiples derate, the P multiples go down, thankfully some support should come by way of earnings growth that we are seeing. But I mean, as a net conclusion, I would say that difficult to argue for a very strong double-digit returns in the market over the next 12 months. That would be the key conclusion.
Would the extension of that argument also be, Mahesh, that even if we were to see strong earnings growth, if rates were to move up, you would believe that it's difficult for the market to follow that earnings momentum because a lot of it has been done already?
That's right. So I would say that FY22, the current financial year, is going to be a very strong year for earnings growth because of the low base, and that's already well known, well factored in. I don't think a 40% earnings growth in FY22 is going to be any surprise anymore. I think the focus is we're going to be on FY23, and what rate do we exit FY22, and what kind of growth we see in the next year. And we are looking at currently about 15% or so kind of an earnings growth. That's what the consensus is estimating at this point in time. So if P multiples were to remain the same, one could argue for a 15% growth or 15% jump in Nifty over the next 12 months. But my basic argument is that the P multiples will not remain the same. So while there will be earnings growth, but there should be some PE rate.
Okay, so both earnings growth may not spur the excitement, and some bit of de-rating could actually bring about maybe some people would say a much needed correction. My question, therefore, Mahesh, is that, and since we've focused on India a little bit, and then I'll of course want to pick up your brains on a couple of other things around the world, but since we have moved to India, what would you believe a portfolio strategy would be? Because like for example, I think about you and your team every time the real estate stocks moved up, right? Because you, for the longest time, have been believers. It's finally starting to play out wherein everybody's now jumping on the bandwagon. My question is, if one looks at the Nifty 50, the argument about the earnings yield, bond yield, etc., is well and truly alive and kicking. But there will be pockets within wherein the earnings growth is expected to be very strong and the valuations are not that strong. So would you believe that even if the markets were to be in a corrective stroke consolidation phase, these individual pockets could actually show meaningful share price appreciations over the course of the next 12 months?
Yeah, I definitely believe so, that there will be certain pockets of stocks and sectors that definitely should give very good decent returns over the next 12 months, 24 months, 36 months. And as you rightly mentioned, real estate and the related segments would definitely be a very exciting space in my view. And it's a broad space in the sense that, obviously the most direct beneficiaries are the developers. But then you have the housing finance companies and the building material companies, and there are a few other ancillaries as well. So I feel that this space is set to deliver outsized returns. I would say over the next even 3 years. I'm kind of willing to take that kind of a call. Because I do feel that the housing market has been in the doldrums for the last 7-8 years. And now all stars seems to be aligning. As a combination of the best ever affordability, we've got a huge pent up demand, and the unsold inventories are coming down, rapidly. And the final icing on the cake, I would say, is the pricing, movement. I think that is beginning to happen, and it's a very healthy price increase. Whatever the information that we have picked up, it looks like the property prices have moved up by anywhere between 5 to 10%. over the last 6 months, and that I believe is a very healthy price trend. Should actually drive more potential buyers to jump into the market, something that they haven't done over the last 5-7 years. So yeah, so to come back to the original question that you asked, Neeraj, yes, we definitely believe that the housing and the related segments, and I think eventually this segment of the economy has the capability to drive the broader capex cycle revival as well. So I would definitely take a positive view on the housing, the capex related plays, the infra related plays, and would definitely prefer that over consumption plays.
Okay, I was going to come to consumptions but before that, I was going to go to banks. But since you've cited that, what about consumers, Mahesh? I mean, how comfortable are you when you sign off on a report of your colleague when he or she is writing about any of the consumer names which are trading at whatever multiples, or at times even the paint companies which have now inched up? But every time I think that Asian Paints is so egregiously priced, they come out with a quarter wherein they surprise on the growth front, even if margins were to be declining a bit here and there. I'm not talking about Asian Paints individually, but I'm just generally using that as an example. What is your thought process when you look at such multiples compared to what you see in the past?
See, I think what has happened, Neeraj, is that over the last 5-7 years, we have seen the consumption stocks have done exceedingly well. The multiple just kept on going up. I mean, one would have argued 7 years back, even 25 times or 30 times is expensive. Then that become 40 and 50 and 70 and 80, right? So clearly, notwithstanding the beginning point, even 5 years back, many of these stocks have done exceedingly well. The earnings growth has been more or less stable at about, say, 15% or so. But the multiple has just kept on going up, and that has driven outsized returns in that segment. And unless and until we see a conclusive evidence that the other side of the economy, which is the investment cycle, is beginning to pick up, I think the consumer stocks will continue to get that benefit of doubt. Because one would have argued the same thing 2 years and 3 years back also, arguing for a derating, but that has never happened. So I think what the market is waiting for is the evidence that yes, the other segment is also now showing promise, and that's when you will probably begin to see the market mood shifting. But I would say that over the last 6 months or maybe even 1 year, we've seen a bit of that already.
Yeah, that's true. That's very interestingly put, Mahesh. Thanks for that. Two questions. Since we're talking consumers, we have a new age consumer company getting listed today. I don't want you to comment on Zomato if you can't, but my question really is that because a lot of your global customers or clients would be wanting a piece of that whole digital or a tech pie, right? And Zomato is the first one. We have a bunch of others coming up. What was your broader thesis around this subject?
Yeah, so this has been one of the common questions from global institutional investors over the last several years, that this is, I mean, internet and the related plays is a very exciting space globally, and everybody wants to take a pie out of that. And we've seen how these stocks have done globally in Europe, in China, elsewhere. But India did not really have any options to play that. But yeah, thankfully now we are beginning to see some options coming up in the listed space as well. So my sense is that given that it is a high growth area, etc., and we know that this space will keep on growing at supernormal level at least for next 10 years, if not longer. So I think the multiples in this space will be ignored by the market. Is what I believe, because as it is, most of these stocks are valued on like revenue multiples and etc., and not really so much on the earnings multiples. And as I said, it is still a very small space in terms of the market cap. I mean, while there might be like 5 listings that might happen in India this year, or maybe 10, I don't know, but still the cumulative market cap is, I don't know, still not crossed maybe 30-40 billion dollars, maybe Maybe I'm wrong on that. Maybe it'll be bigger than that, but
Sure.
it is still going to be a relatively smaller space in terms of float, etc. And we have seen the kind of sort of behemoth exist in China and elsewhere in the world, and the kind of returns that investors have made. So my sense is that this is clearly going to be an exciting space. And while the investors will keep on complaining about the valuation multiples, but they will still be buying it.
Okay, Mahesh, my final question to you. I love that line, by the way. That's going to be the headline of our story that we do on this interaction. But Mahesh, my final question to you. As a Zomato, as some of the others, companies which are high, high PE, come in, and eventually, if they do find a space in the index, that's the common conversation these days, right? That they will wedge out some of the old age companies, economy stocks out, and they will come in. So optically, the Nifty PE, whenever these guys make a meaningful presence, will look obscenely high, right? Because the PEs. So how does one then get into it? Because the historical standards of measuring the or having a benchmark Nifty PE versus then would be materially different. I know we are maybe a few quarters or a few years away from there, but I'm just trying to pick your brains here. What would you think will happen then?
Yeah, Neeraj, so this is a constant phase of evolution that Nifty has been and the market has been. I mean, look at Nifty, what it looked like in 90s, and then 10, 15 years ago, and what it is looking now. And the weights have changed quite a lot. I mean, today the Nifty is very, very financials and IT heavy. I mean, financials account for, I think, 37, 38%. IT accounts for another 15, 16%. Both of these sector add up to about 55 to 60%. So financial was a much smaller sector 15 years back, when there wasn't really 15, 20 years back, when there weren't that many private sort of companies, banks that were listed. So yes, I mean, your question is right that as the Nifty composition changes and changes towards high PE sort of stocks, the multiple itself will look different. And yes, I mean, we will have to kind of look at more bottom up sort of analysis and what the individual stocks are doing. In fact, why just Nifty? Many of the companies have changed their profile. I mean, there are a few auto companies, and there are some metals companies, and there are a few whoever that has made some large acquisition. Suddenly the business profile and the P multiple changes. So I think it is going to be a continuous process. But I still believe that I don't think that Nifty P multiple itself will lose its relevance. But yes, but we'll have to look more from the bottom up perspective as well.
So sorry, I'm just stretching this, but just one quick, very last question, Mahesh. What would in such a scenario determine whether the Nifty is expensive or cheap? Because I mean, the Nifty PE will look elevated. So how do you, when you write a report, say that the Nifty is expensive or the Nifty is cheap? That's my question. It's okay if you don't have an answer right now, but yeah.
No, it's not very difficult because, as I said, we have gone through this evolutionary phase over the last several kind of the last 2-3 decades, and the next decade will not be any different. So, there is, always, ways and workarounds that. I mean, you can always look at the P multiple X of,
of
stock A, excluding stock B, excluding stock C, whatever, you can think of. So those kind of things can be done.
Okay, got it. Mahesh, lovely talking today. Thank you so much for your time, and wishing you all the best for the year ahead. Please stay safe.
Thank you very much, Neeraj, and all the best.
Thank you. And viewers, thanks for tuning into this conversation.